Hi ladies and gentlemen, this is Game of Trades and this is going to be an analysis of the S&P 500. This video will cover the fundamental situation of the stock market in my eyes. I'm also going to quickly compare the S&P 500 to the Japanese stock market. I think there are many similarities between the two, so that's definitely something to look at. And then we're going to take a look at the longer term charts right now and see what kind of developments to watch that could potentially trigger big moves right now on the S&P 500. Whether you're looking for lower lows or all-time highs, we'll take a look at that from a technical standpoint. Before I move on, make sure to like and subscribe to the channel if you haven't already. These kind of videos do take a little bit longer to prepare, so it is very appreciated. So I'm going to start off by taking a look at this chart highlighting the S&P 500 versus the assets of major central banks. And what this basically is the combination between the Fed and these two central banks. And you can see there is absolutely no denying this correlation between the stock market in red and the blue line representing the assets of the Federal Reserve and central banks. And so this is where the entire "don't fight the Fed" argument stems from. When the Fed decides to print money to have a quantitative easing policy to lower interest rates, well, the markets go up. And that's been the case for 10 years. And so this chart does not include the recent drop in the stock market, which would look something like this. But what's also happened is that the total assets of the Fed has increased massively. And so it's reasonable to suggest that the stock market would follow this correlation again and resume the bull market that we've seen over the past 10 years. And so this is really where you have to pick a team. Either you are 100% confident that the Fed is able to push the stock market higher despite the economic environment being completely wrecked, and so we would never see a real bear market again. Bear markets are a thing of the past and we are going to only see bull markets from now on. Or you believe that the Fed can only do so much for the stock market, and that when consumer confidence goes away, when fear sets in, the stock market will go down regardless of what the Federal Reserve can do. And it is a complete guess. I mean, we don't have that much data. Recently, we only have 10 years of data, and this was a full-blown bull market. We had no fear. We had no crisis. We didn't have shutdowns and big drops in unemployment and huge market volatility during this time. So we don't know what the Fed can really do about degrading economic conditions. And so we can take a look at Japan for that, because they did have very similar monetary easing policies to the United States during their recession. This is the Japanese stock market index, and you can see that they were in a bear market since around 1989 all the way to 2009. A huge, massive bear market. And the Japanese government tried to stimulate the economy several times during this bear market with stimulus packages, exactly like what's happening right now. But guess what? The stock market kept on going down because the fear was there, the lack of confidence was there, and eventually the Japanese stock market dropped around 80% all the way to the lows. So does that mean that the stock market can drop 90% over the next 10 years? Well, no, not necessarily. It's not exactly the same situation. The point of this graph is that stimulus packages do not necessarily always keep the markets up. And I think it's important for investors to remember Japan as an example of that and not be put into a false sense of confidence in the stock market. The truth is we have a lack of data around this type of monetary policy. We don't have that many examples of developed countries trying to print their way out of a recession. And so in the long term, I think it is very difficult to say exactly what's going to happen. But my take on it is that this situation really does not bring me a lot of confidence in the long-term aspect of the stock market. I think the Federal Reserve is really heading 100 miles an hour into fog, and they're really risking this type of lost decade situation in the US. And the worst part about it is that we're already seeing signs of this happening just like it did in Japan. We're seeing companies that are surviving an economic crisis that really should not be surviving and are not fit to survive. And I know that may sound harsh, but that is how an economy comes out of a crisis stronger than before, by eliminating the weaker parts of it. And so I want to show you a very interesting chart showing this, and that is the S&P 500 versus zombie companies. Now that may sound scary, but it's actually quite simple. What these zombie companies are is companies with poor fundamentals. So these are companies that have very little value compared to the actual earnings that they make. They are basically debt financed companies that don't really participate in the economy in a very impactful way. And so you can see this chart measures what proportion of zombie companies can be attributed to gains on the S&P 500. And so the closer you are to that corner of the graph, the more you've got these debt financed zombie companies that are pushing the stock market higher. And you can see we've got April 2020 here as the winner on this chart. And it really makes sense with the current monetary policy, with the Fed printing huge amounts of money, with the stimulus package. We've got a stock market that is being pushed by these companies. So that doesn't really tell us where the stock market will go. It's just for information purposes, but it just goes to show you that what's happening right now is really not very capitalist. I mean, these companies, these zombie companies, really should not be surviving. And so what you'd expect during a time of crisis is that the economy has a tough time. We've got companies with poor fundamentals that do not survive, that just disappear, and you've got the tough ones that are left standing. And so what this means is that if our economy does come out okay, if the stock market does climb higher, the economy is basically going to come out of this crisis more fragile than ever, with more companies that do not contribute to the economy more than ever. Now we're going to move on to the actual S&P 500 chart, and we're going to take a look at exactly what developments we need to see on the charts that could trigger longer term moves on the S&P 500 that could last weeks, if not months, telling us whether we are really in a new bear market or if we're just continuing the old bull market for another leg up to all-time highs. So this is the weekly chart, and I'm going to keep it very simple. We're going to take a look at two specific things that could trigger signals long term. We're looking at the 40-week exponential moving average that I've talked about before, and we're looking at this long-term bull market uptrend line. So I'm going to zoom out right here so that we can get a sense of exactly what these two indicators mean. Now, first, the exponential moving average, one of the better moving averages that capture bull and bear markets. You can see when the price is above, it generally stays above, and when the price is below, it generally stays below and captures the majority of the bear market. And so being below this exponential moving average is a sell signal, but popping back above it is a buy signal. Now, like any other indicator, it's not perfect. There are whipsaw signals. We saw one in 2015 and one in 2018 recently. But you can see in both of those cases, when we pop back above it, we had a big rally. Same thing here. We popped back above it. We had a big rally. These were bullish developments. So if in the coming weeks you see a pop above this 40 exponential moving average, it is a bullish development and will likely indicate more upside in the coming weeks. Now, I do not favor a scenario like that. We are still below this exponential moving average. In fact, we rejected right on it a couple of weeks ago. But if the markets, let's say, manage to have that short-term pullback that we talked about in the last video, come back down to this trend line and then have another leg up and push through this exponential moving average, that would be bullish. That would be a bullish breakout. But right now, we're pretty much sandwiched between this long-term indicator and this trend line. And again, with this trend line, you can also see its significance from the low in 2009, how the markets have bounced repeatedly on this trend line, kept the market up, and we recently obviously broke below it and then popped back above it. So right now we're really sandwiched between these two indicators. But you can see that if we break back again below this trend line, that would be a long-term sell signal. You can see when the markets break long-term trend lines, they usually trigger bear markets. So those are the two signals to watch, whether you are bullish or bearish. These are definitely accurate long-term indicators that you can use for your investments. Now, does that mean that if we break above this exponential moving average, I'm going to be all bullish, all invested into the S&P 500? Absolutely not. As I've demonstrated through this video and through many other videos, I have very little confidence in the economy right now. All a breakout would do would be increasing the amount of long trades I make. And that's very important in your trading to know whether the markets are long-term bullish or bearish. It can really help you have a bias in your trading and what to expect from bullish and bearish trade setups. I still think there is tremendous opportunity to the downside. A break of this trend line will likely trigger much more longer-term bearish implications. And I think anyone that is ready for that will be making a lot of money. Now that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe if you haven't already. In the meantime, good luck on your trading and see you next time.